Silver isn't just rising, it's being repriced in real time, and the people treating this like just another spike are staring at the wrong screen while the real pressure builds underneath. Because right now there is a conflict in the silver market that doesn't cheer to show up in a clean little headline. The paper price can print a number, but the physical and regional bid is fighting for priority, and the moment that tug of war turns into a pipeline problem, the move stops looking emotional and starts looking like math. And I am going to give you the exact roadmap for what matters over the next week or two. The levels that have to hold, what would confirm the thesis, what would weaken it, and the two scenarios that catch most people on the wrong side, especially the one where a pullback is the more normal thing that actually sets up the next leg. Now, let's anchor this in what the market just did, because the speed matters more than the number. Silver started January around the low 70s per ounce, then it didn't meander, it didn't politely trend, it lurched, pushing up into the 80s, then pressing into the 90s by mid-month, and it did it with the kind of daily ranges that don't just move price, they move people. That's the first proof point, and it's not a vibe. It S the tempo. When a market can climb from roughly $71, $73 at the start of the month to over $93 within about 2 weeks, you're not watching normal demand, we're watching a repricing process, where participants are being forced to make decisions faster than their risk systems like. And that's where the real pressure starts. Because as soon as silver starts moving like that, the debate turns into a trap. One side says, it's overdone, it has to crash. And the other side starts chanting targets like the market owes them a clean staircase up. Both sides get punished if they ignore the mechanism. And the mechanism is the whole story. Here's the part most people miss. In metals, spot is a headline, but the spreads are the message. The difference between nearby and later contracts, the way the curve behaves, the way regional pricing diverges, those are the places where you see stress before you see it on a simple chart. And when stress shows up, it forces behavior. That's the so what. If spreads tighten aggressively, if nearby availability becomes more valuable than future promises, it pushes commercial users to secure supply now. It pressures shorts who assumed they could roll forever, and it turns the whole market into a timing game. But that's not the part that matters most yet. The part that flips the setup is the hidden detail. Silver isn't only one market. It's a chain of markets connected by logistics, financing, hedging, and sometimes outright friction. When one region is willing to pay more, whether because industrial demand is urgent, inventories are tight, currency dynamics change, or import flows get constrained, that regional premium doesn't stay politely over there. It becomes a magnet. It pulls on the entire chain through arbitrage, and arbitrage is not magic, it's plumbing. If Shanghai is paying meaningfully above London, if Asia is bidding more aggressively than the West, traders try to move metal, hedge exposure on futures exchanges, and capture the spread. That attempt to close the gap is exactly how a regional premium can drag the global benchmark higher, and the pipeline has limits. There are lead times, there are refinery and fabrication bottlenecks, there are shipping constraints, there are financing constraints, and there are moments when the hedges become the driver because the physical move is slow, but the paper reprices instantly. That S, the hidden detail, the price can look like it running ahead, when in reality it's racing to catch up to a pressure that started somewhere else. And that is why silver S momentum can build faster than forecasts, because forecasts tend to assume smooth transmission, and the real world transmits in bursts. Now zoom in on the conflict everyone feels, but few can articulate. The bearish case screams, this is a blow-off, because silver has a history of explosive moves followed by nasty reversals. That history conditions people. They remember the whip. They remember margin calls. They remember how silver can rip your face off in both directions. But the mistake is thinking that volatility equals falsity. Volatility is often the tax you pay when a market transitions from nobody cares to everybody has an opinion, and that transition forces positioning to reset. That's where the real pressure starts again. Because if the move is driven by structural demand and tightness signals, then volatility is not a reason to short. It's a reason to respect the risk and choose your time frame. But if the move is purely leverage and narrative, then volatility is the warning flare that the whole thing can unwind on air. The difference between those two worlds shows up in the proof stack, and we're going to build it. First proof point, we already said it, the velocity. Second proof point, the character of the pullbacks. When silver can print a high in the low to mid 90s and then within a day trade down into the mid to high 80s, you're not watching a sleepy market where only long-term holders participate. You're watching a battlefield where liquidity thins, stops cluster, and forced flows hit like waves. On one session alone mid-month, the market traded from the low 90s down toward the mid 80s intraday before bouncing. Moves that Donnie T just shake people out. They also force dealers, funds, and hedgers to adjust. But that's not the part that matters. The next detail is what flips the whole setup. Exchanges respond to this kind of volatility, and the response changes the game. Around mid-January, the CME announced changes to how it sets margins for precious metals, shifting toward a percentage of contract value approach in the context of elevated volatility. Translation: when price jumps, required collateral can jump with it, and that creates forced decisions. That's a market structure driver, not a narrative. Margins are the hidden hand that turns "I can wait" into "I have to act today." And when margins rise, we can sell, but the market doesn't necessarily die. Sometimes it does the opposite. It liquidates the fragile leverage, then clears space for the stronger trend. That's why silver can look like it's about to top. Then it rips again after the most emotional participants have been removed. And that's where the real pressure starts, because people interpret that as manipulation when it's often just risk management logic colliding with a thin market. Now layer in the street symptom, because silver is one of those markets where the physical world leaves footprints. There have been reports that U.S. retail investors haven't been chasing this move the way you'd expect. In some cases, coin dealers describing more sellers than buyers, discounts in certain types of old coin silver, and a kind of weird lethargy in the classic retail channels, even as the price screams. That matters because it tells you who might be driving the marginal bid. If retail isn't the primary engine, then you look elsewhere. Overseas demand, institutional allocation, industrial procurement, and hedging flows. And that's not a conspiracy. It's incentives. Big money doesn't need to post memes. It needs liquidity, it needs hedges, it needs to not blow up. If institutional or overseas flows are carrying the rally while retail hesitates, that can make the move more durable than people assume, at least until price becomes so high that it starts destroying demand. And that's the counterpoint you cannot ignore. Because silver isn't just a precious metal story, it's an industrial input story. As prices surge, some industrial users try to substitute, thrift, redesign, or delay. And we've already seen commentary along those lines, that high prices can push fabricators toward alternatives, that some solar-related companies have explored shifting to cheaper materials where possible, and that at some point the industrial buyer's pain threshold becomes the rally's ceiling. That's a real mechanism, and it's why you should never treat silver like a pure monetary metal. If the bid is coming from a mix of investor demand and industrial need, then the move can be powerful. But the higher it goes, the more it invites adaptation. But here's the twist. Adaptation takes time. Redesigning a manufacturing process isn't like switching lunch orders. There are qualification cycles, reliability testing, supply contracts, and a whole chain of "we can't risk failures." That lag means the industrial demand response can be slow at first, which is exactly why momentum can build faster than forecasts. Price can overshoot before the real world demand response catches up. And that's where the real pressure starts. Because overshoot is where the biggest money is made, and the biggest accounts get wrecked, depending on whether you retrading the noise or positioning for the trend. Now let S make the core mechanism painfully clear with a simple picture you can hold in your head. Imagine two prices for the same metal in two different places. If one region is paying more, the natural trade is to buy where it's cheaper, move the metal, and sell where it's more expensive. But silver isn't a video game item you can teleport. You need bars that meet specification, you need logistics, you need insurance, you need financing, you need time. And while the physical metal crawls through that pipeline, traders hedge price risk using futures. That hedging creates futures demand even before the metal arrives. So paradoxically, a regional physical premium can create immediate paper buying pressure because the arbitrageurs are hedging their exposure. And if enough people run that trade at once, it tightens supply expectations, changes spread behavior, and forces other participants to respond. That is the exact moment when the price stops being just a chart and becomes an ecosystem. But that's not the part that matters most this week. This week, what matters is how the market expresses tightness. And tightness in commodities often shows up as term structure stress, nearby contracts getting bid, spreads narrowing, backwardation threatening to appear or deepen. You don't need to obsess over jargon. You just need the translation. When the market pays you less, or even charges you, to hold a longer dated contract relative to the nearby, it's telling you that now is valued more than later. That can happen when inventories are tight, when demand is urgent, or when there's distrust in future supply. And when that happens, it forces behaviors. Shorts can't just roll forever without cost. Consumers are incentivized to secure supply sooner. Dealers managing inventory get squeezed, and speculators who bet on a clean mean reversion get trapped because the cost of waiting goes up. That's the kind of pressure that builds momentum faster than forecasts. Because forecasts tend to assume availability, but spreads tell you about immediacy. And that's the hidden detail most people miss. Now, inventories. This is where people get fooled, and it's not their fault. Inventory headlines can be technically true and still useless. In exchange warehousing systems, there is often a difference between metal that exists in approved warehouses and metal that is registered or deliverable against contracts. You can have a lot of metal sitting eligible, but not committed for delivery, and that distinction matters because price discovery is ultimately about what can be delivered when someone demands it. If deliverable supply is tight, spreads can tighten even if total reported warehouse stock looks fine. And if that tension grows, it becomes a psychological weapon. People see inventory exists, so they dismiss the rally as hype, right up until the moment delivery stress shows up in spreads, premiums, and behavior. And that's where the real pressure starts, because then the market stops debating and starts repricing. Let's talk about the psychological warfare of silver, because you need a shield. Silver is a master at manipulating your emotions without anybody needing to manipulate on the market in the cartoon sense. The manipulation is structural. It comes from thin liquidity at moments, from leverage in the futures market, from clustered stops, from margin policies, from the way headlines hit during liquid windows. If you're not prepared, silver will make you chase breakouts and then panic sell the first pullback, even when the larger trend is intact. So here's the shield. Separate trend signal from noise. Trend signal is the ability to hold above key breakout levels after volatility, the persistence of demand despite drawdowns, the behavior of spreads and premiums, and the pattern of higher lows after liquidation. Noise is the intraday whip that's designed, by structure, not by some villain, to find leverage and punish it. The market doesn't know you. It just knows where liquidity is. And that's why this matters right now, because we're entering a part of the calendar that amplifies these dynamics. Mid to late January isn't just another week. You have option expiries on the horizon, you have futures roll, and delivery cycles that force decisions. You have month-end portfolio and risk adjustments that can change flows, and you have the simple reality that when volatility spikes, risk managers tighten the leash. Calendar pressure is the catalyst nobody respects until it hits. And when it hits, it can create two very different outcomes. A controlled pullback that resets the move, or a continuation squeeze where price gaps and participants scramble. The difference comes down to positioning and liquidity, which brings us to the big institutional question, who's actually on the hook here? If the rally is driven primarily by fresh long positioning with weak hands, then rising margins and a volatility shock can unwind it hard. But if the rally is partly driven by shorts being forced to reduce exposure, by hedgers needing to cover, by industrial or overseas demand that can't be switched off overnight, then pullbacks become buying events, not endpoints. And that's where the real pressure starts again, because the crowd is trained to treat every pullback as the top, while structural markets treat pullbacks as inventory. Now, let's put a framework around what to watch without pretending we can predict with magical precision. First, the big round numbers matter more than people want to admit, because they're where options positioning, psychological anchoring, and stop placement cluster. In this move, the $90 zone has been a magnet. Break above it, fail back under it, reclaim it, lose it again. That's not superstition, that's market microstructure. Dealers and funds often manage exposure around those levels because that S, where gamma and hedging needs, can change quickly. You don't need to model the whole options book to respect the idea. If price is pinned near a major level, small moves can trigger mechanical flows. If price breaks and holds, the flows can chase. And if price fails hard, the unwind can be violent. Because if this one level breaks, the math changes. Second, watch the character of dips. A healthy trend often pulls back, retests, and finds buyers without collapsing into a cascade. An unhealthy blow-off often fails to find a bid quickly, spreads widen, and price starts to behave like it's hunting liquidation rather than discovering value. Third, watch whether physical signals calm down or intensify. You don't need exact premium numbers, you need direction. If regional premiums and tightness symptoms remain persistent while futures remain volatile, that suggests the underlying bid is still there. If physical tightness eases and the only thing left is leverage trading, that's when momentum can stall. Fourth, watch the macro crosswinds, but don't let them hypnotize you. Yes, a stronger dollar and shifting rate expectations can pressure precious metals, and you can even see that tension reflected in local markets, like sharp moves in Indian silver pricing on the MCX when global sentiment shifts. But silver can decouple when the microstructure and the supply-demand chain dominate. If silver is holding up even as macro headlines lean against it, that's information. It means something else is overpowering the typical headwind, and that's where the real pressure starts, because correlation breaks are often a sign of regime change. Now the counterpoint, because credibility demands it. This move can absolutely whip around violently, even if the thesis is correct. Price can drop 10% in a day and still be in an uptrend. That's not a contradiction, that's silver. So the risk management lens matters more than the target. If you're a long-term believer in the structural case, tightness, industrial demand inertia, regional premiums, institutional allocation, then your enemy is not being wrong. It's being forced out by volatility. That's why time horizon is a weapon. If you're a trader, your enemy is pretending you're an investor when the market turns, and your enemy is using tight stops in a market that routinely moves more than your stop just to breathe. But that's not advice to be reckless. It's a reminder that you have to match your tools to the market. Volatility is a tax. If you don't budget for it, the market will collect it from you, and the market is very good at collecting. Now let ES bring it home to the why now and what comes next, because that's what you're really here for. Silver S momentum is building faster than forecasts because the market is dealing with multiple forces at once. Rapid repricing on the headline chart, structural pressure visible in how participants behave under margin and volatility changes, and the possibility that regional and physical signals are pulling on the global benchmark through arbitrage. Add in the calendar, rolls, expiries, month-end risk, and you get a setup where the next 1 to 2 weeks can be decisive, not because fundamentals magically change overnight, but because positioning and deadlines force choices, and forced choices move markets. So here are the two scenarios you need in your head, because they keep you sane. Scenario 1 is the controlled pullback and retest. In this scenario, silver can't just levitate. It pulls back toward a key zone, think the upper 80s or the prior breakout area, shakes out late longs, calms the euphoria, and then finds a bid that holds. Confirmation looks like this. The pullback is sharp, but doesn't unravel into a series of lower lows. Rebounds are fast. The market stops accepting trade back below that reclaimed level. And volatility, while still present, starts to look like it's being absorbed rather than escalating. That absorption is the tell. It's the market saying, we found buyers who aren't panicking. And that's where the real pressure starts for shorts, because every failed push down becomes fuel for the next push up. Scenario 2 is the continuation, squeeze, and gap risk. In this scenario, silver doesn't give polite entries. It consolidates briefly, then rips through a major level. Again, round numbers matter, and liquidity thins right when it matters most. If that happens near an options and hedging inflection point, the move can feed itself as dealers hedge, shorts cover, and momentum funds add. Confirmation here looks like clean breaks with follow-through, shallow pullbacks, and a market that keeps closing strong after attempts to fade it. Now, the risk is obvious. Gaps. You can wake up, and the market is simply somewhere else. That's why this scenario rewards being early and punishes being late. But it also punishes being overconfident, because squeezes can reverse just as violently once the forced buying is done. And that's where the psychology shield matters most. If you don't have a plan, the market will hand you one, usually right at the worst moment. So what invalidates the bullish momentum thesis in the near term? It's not a red day. It's not a scary headline. Invalidation looks like sustained failure to hold reclaimed levels after multiple attempts, especially if those failures coincide with easing physical tightness signals and a shift in flow behavior that suggests the marginal buyer has left. Invalidation also looks like the kind of breakdown where rallies become weaker and slower, while sell-offs become faster and deeper. That's the signature of a trend that has turned from repricing into liquidation. If you see that, you don't argue with it, you respect it. Because even if the long-term story remains, the near-term tape can punish you. On the flip side, what confirms the thesis? It's the market acting like it has unfinished business, holding above key levels despite volatility, recovering quickly from margin-driven hits, and continuing to show signs that demand isn't just speculative froth. Watch for the moments when the market gets slammed and then refuses to stay down. That refusal is information, and that's where the real pressure starts, because it tells you selling is being absorbed, not celebrated. Now, a quick word about institutions, because skeptics of institutions are right to focus on incentives without falling into fantasy. Institutions don't need to conspire to create outcomes. They just manage risk in ways that can look predatory from the outside. Dealers hedge, funds rebalance, exchanges protect themselves with margin policies, commercials hedge production and procurement. None of that requires a secret meeting. It's just a system. And systems create patterns. One of those patterns is that volatility gets used against you. Big moves are engineered by structure to trigger emotional decisions. First, the market runs without you, making you feel stupid. Then it dumps hard, making you feel relieved you didn't chase. Then it recovers fast, making you feel like you missed it again. That emotional loop is how people get chopped to pieces. The shield is simple. Define what matters before the move, not during it. Decide what level matters. Decide what confirms and what invalidates. Decide your time frame, and then let the market do its thing. If you can't do that, silver is not the market to wing it in. It will punish improvisation. And that's where the real pressure starts for most viewers, because the temptation is to treat this like entertainment instead of a risk environment. If you're watching this and you feel the adrenaline, good. Use it to pay attention, not to press buttons. Here's your concrete checklist for the next week or two. 1. Does silver hold above the key reclaimed zone around the big round numbers, or does it keep slipping back under and staying there? 2. On sell-offs, do we see fast recoveries and strong closes, or do we see dead cat bounces that fade? 3. Do signs of physical and regional tightness persist, or do they cool off in a way that suggests the urgency is fading? 4. How does the market behave around the calendar pressure? Roll windows, expiry dynamics, month-end adjustments? If volatility spikes into those windows and price still holds, that's a powerful signal. If it breaks and can't recover, that's a warning. 5. Watch your own psychology. If you catch yourself needing the market to do something, you're already in danger. You don't need certainty, you need a process. And if you want to be part of the tiny group that survives these moves and actually benefits from them, you have to be the person who can sit through noise without turning it into a story. That's the identity piece, not bull or bear, disciplined. Mechanism first, evidence-driven. If that's your tribe, you're in the right place. And here's the final pull forward. The next time silver gets hit hard and the internet declares it over, don't listen to the volume, listen to the behavior. Because if the underlying pressure is still there, that's when the market sets the trap for the next leg. And the people who understand spreads, flows, and deadlines are the ones who want to get shaken out right before the move they were waiting for.